After losing $50,000 in the syndication I told you about during the last episode, I realized that my biggest mistake wasn't trusting the wrong operators. It was not having a systematic way to evaluate deals quickly and consistently. Welcome to the Alternative Investing Doctor podcast. I'm your host, Dr. Keith Grosshans, and in today's episode, we're going to be discussing how I analyze note deals using my systematic checklist, using a real case study. As we discussed in the syndication episode, some of the challenges with syndications is you're basically writing a check and really just putting all of your trust and faith in the deal sponsors. And you really have to believe that they know exactly what they're doing, that they really understand the market, they understand what the expenses are going to be, and that they're going to operate the business efficiently and profitably. What I like about note investing rather than syndications is there is an extra level of control, right? Rather than just writing a check and hoping that the sponsors do what's best for me as the investor, I can take ownership from the very beginning. I can control the whole due diligence process and really manage my risk before I ever write a check to purchase an asset. To assist myself in doing this efficiently, I went and developed myself a checklist that I like to use for each deal that I analyze. It's not efficient to completely analyze every deal, so it was really important for me as I was building out my checklist to be able to rule out bad deals quickly so that I could save more time to go through deals that would actually be good fits for my portfolio. On the flip side of that, going back to syndications, you're often going to be presented with a beautiful looking offer memorandum, maybe a 40-page or longer pitch deck with pro forma rent projections, market analysis. It all looks very sophisticated, and in some cases it certainly is, but realistically you're putting a lot of faith in those documents, and if something starts to go wrong, there's very little you can do. Your capital's more or less tied up for at least 5 years in most cases. There's not really a way to buy yourself out of those situations. There's not really any liquidity built into those investments. I'd gone through trainings for apartment syndication and spent time getting to know operators and deal sponsors and kind of understand the ins and outs of the risks of the business. But even still, there are so many unknowns, especially when the market is shifting or moving fast. Things can change more quickly than you might expect. And unless you have years of experience or are working with syndicators who have been through many market cycles, it's very easy to overlook individual problems or red flags that could come up during the deal analysis. And so I wanted to make sure that as I dove deeper into note investing, that I would put together a strategy for myself that would allow me to avoid some of the mistakes that I made on the syndication side. So having a good checklist in place is kind of my insurance policy to avoid making expensive mistakes and make sure that I'm only putting out offers on deals that are good fits for me and for my portfolio. This has certainly saved me from multiple deals that looked good on paper, but digging deeper, they had fatal flaws. And with my checklist, I'm able to catch those in minutes rather than in days or weeks or even months. So let me show you exactly how this works. Just last week, a $57,000 note deal landed in my inbox, and everything looked perfect. So with all that context, let's dive into the actual deal analysis. Here's how I broke down this specific case study.
It had a good yield, recently renovated property, and a performing borrower. My due diligence framework killed it in 5 minutes flat before I even considered submitting an offer. Here's how it cuts through the sales pitch. This was a real deal that I analyzed recently. I'm going to keep the specifics of it anonymous, but the seller pitched it perfectly. An investor had just renovated the property, and the borrower was making on-time monthly payments. The yield looked very attractive for the risk level. On paper, this checked a lot of boxes, But I've learned that paper and reality don't always match. I use a systematic approach for every deal. It takes less than 30 minutes, often much less, to determine whether I should bother looking further into a deal or throw it in the junk bin. Today, I'll show you how it worked on this specific case. First thing I looked at was the state, and that checked out. It was a state I was comfortable investing in. The initial numbers review looked good. It had a good yield and a nice unpaid principal balance. But once I got to the assessment of the underlying collateral, the actual property, and my value analysis of that property, these were when I started to see the red flags. And then on top of that was the borrower profile, which really threw up some warning signs. I didn't even make it onto the tax status or onto the documentation steps of the framework. So those first two steps looked fine, but really once I hit step 3, that's where things started to fall apart. The first red flag was the neighborhood. On my assessment of the neighborhood, simply looking at Google Street View, I started to see that the neighborhood had a lot of poorly maintained properties that were not in very good shape. Just 5 minutes cruising up and down the streets on Google Street View told me everything that I needed to know. There were houses that had roofs that looked like they were caving in, paint that was peeling off of the siding, and rusted cars sitting in the front yard like permanent lawn decorations. This certainly wasn't a neighborhood that looked like it could support the property values that the listing claimed the property was worth. One of the key points of the listing was that there were recent renovations. And that's great. So someone spent the money fixing up a house, but that doesn't help when the rest of the neighborhood is in decline. That's not really a good asset in my books. That seems like more of a liability. Then in the fourth step, I started looking at the value analysis. This is looking at the loan to value and investment to value calculations. And this is where my Notion template automatically flags deals that exceed my risk thresholds. By the numbers, the UPB, or unpaid principal balance, was $55,000. The property was supposedly worth $57,000. That puts it at a 96.5% loan to value ratio. My system automatically flags anything above 80% LTV for review. Why is that? Well, because the borrower has essentially zero skin in the game. They're close to being upside down from day one. A small market dip means that they would actually be underwater. And when people have no equity, they walk away pretty quickly when life gets complicated. Just look at the 2008 financial crisis if you need some more examples. Also, there's a reason that banks use 80% as their standard loan-to-value ratio for most mortgages. It decreases the risk in a default scenario for the lender significantly. I already knew that this deal was on life support, but by the time I got to step 5, which is the borrower profile, that's what really sealed this deal as a pass. This loan was originated back in May of 2025. We're talking barely dry ink on a performing loan. Think about this scenario. An investor renovates a property, immediately seller finances it, then sells the note within months. In this scenario, it looks like this property was fixed up by an investor, sold on seller finance terms, and then the note was immediately sold to cash out. While we do sometimes see this in the note industry, often in these cases, there's going to be a much larger down payment to provide some cushion and some safety net for investors who might want to come in and buy these fresh and unseasoned notes. This felt more like someone who was trying to get out fast, maybe because the neighborhood didn't quite match their investment criteria. When I started looking around for neighborhood comps, not just the optimistic valuations, I realized the property was probably worth more like $35,000 to $40,000 max. So in this case, I'd be paying $57,000 for a note that's secured by a property that's maybe $35,000. That didn't seem like a very good idea to me. That seemed like wishful thinking. This is the power of having a systematic approach. Framework didn't just help me quickly rule out a deal, but it helps me not even get emotionally invested in anything that's not going to work out. I developed this system so that I could be consistent and make sure that I'm making investment decisions based off of sound fundamentals in math rather than emotions. And now my system kills bad deals before they waste any of my time or tempt me with any fake opportunities. The framework caught this in under 5 minutes for this deal and ruled it out. Without a solid framework, it'd be easy to spend hours analyzing a deal that's fundamentally flawed. That's not just expensive, it's inefficient.
So that wraps up the discussion of the case study using my checklist to go through a real life deal and why it did not pass my screening and never even entered into deeper due diligence. I think that this overall process is crucial for physicians who are busy, where you're not chasing bad deals and tying up your valuable time. What's also nice about having a very systematic approach is that when you do get deals that pass your screen, you can feel more confident. This can help you to overcome some of the analysis paralysis that is very common in the investing world. This fits with my philosophy of trying to keep my investing time efficient. I don't want this to be a second full-time job. I want this to be something that I can do in my off time without sacrificing my hobbies and time with my family. And the reason that I'm doing this and think this is important is because this is a way that I can help to build myself financial flexibility, and that's a way for me to regain my autonomy as a physician. As there's ever-changing demands on the clinical side of my career, I want to be able to have options and flexibility for changes in the future. And I think that's why note investing can be a very valuable tool for physicians to add to their portfolios. And I think this strategy works very well for physicians who are not necessarily looking to leave medicine, but looking to gain that additional autonomy back that maybe you've been losing, to give yourself more flexibility, maybe to reduce your hours. This can help avoid burnout and just make your overall career more sustainable and enjoyable. And that's really something that I think is important. So if you want my complete template as well as my checklist, go ahead and check out the link in the show notes. Until next time, keep working towards your freedom and building that flexibility.